If I'm just going to stick to fixed investments, I'm going to end up like my parent. This bull run will end soon. If you look around and talk to people, they are acting like the party is never going to stop.
So nowadays, like everybody, especially in Gen Zs, like they want to get financial independence before 40. So is there any formula to it?
Early financial independence, if your expenses are X, I would recommend investing at least every month. Young people spend a lot of time wasting time on cryptos, trading. Either you're going to lose a lot of money or you're going to lose some of your health. And what youngsters do is they have this app where they can buy mutual funds. They shop like you shop in a supermarket. It's like, every time you pick up a pack of smokes, you see a guy with lung cancer right there on the picture and you still smoke.
Is intelligence correlated with money?
In my 8th standard, I flunked almost all my subjects.
So how would you do it if you had to start all over again? Hi sir, welcome. So I think first thing is what we'd like to know is how was your journey from starting from wherever you started and basically going to financial independence. So for our viewers, I think we just want to understand how your journey has been and if you could give some perspective around it.
Yeah, so I was basically a head in the clouds kind of academic. I knew nothing about personal finance or most aspects of life. All I knew was my lab, and I spent most of my time there researching on physics and so on. Before I got my first position, my tenured position, I was thinking about teaching, whether to take up a teaching career or a research career and so on. And just a few days after I got my first salary, my father fell sick. And he had a condition called multiple myeloma. And because of that, the hospital bills quickly, zoomed up. And I had no money to pay them. Then I had to rely on a loan from my brother-in-law and take care of that. So that taught me the importance of both independence as well as money management. And I told myself that I should never be in such a position ever again. So that's how it all started. And my journey is it's a very unexciting journey. It's very based on basic discipline and regular investing and simple adherence to asset allocation. And so I started with 1,500 rupees SIP in June 2008 and slowly started increasing it more and more and more. And that's how it all began. So it's a very, what I would like to stress to people who watch this is, if you are disciplined and patient and give yourself at least 10 years, your life can change. Unless if you chase after get rich quick schemes and burn yourself, that kind of thing is wrong. Just be patient and disciplined. So that's all. It's a very unexciting journey. Doesn't appeal to me though.
So nowadays, like people are thinking about obviously financial independence, and everybody, especially in Gen Zs, like they want to get financial independence before 40. So is there any formula to it? Because you are helping SEBI also with the calculators and everything. So is there any formula like what should be the corpus after which we can feel that yes, now we can retire?
I have a feeling that many people are asking the wrong questions when it comes to financial independence. In my opinion, they don't understand or truly appreciate what it means. And if you ask them what they will do after, let's say, they actually hit financial independence by 40 or 45, which is a pretty long shot for many people.
Right.
It's easier said than done. And they don't have a clear idea. It's just that they have very stressful jobs and they don't want to be working under their bosses. They have a bad employer or that kind of a thing. They don't want to, it's too stressful for them, and that's why they earn for financial independence. And they want to have get it ASAP. But I think a little more balance in life is better for most people. At least for the typical salaried Joe, I would say some kind of better work-life balance would help them. But achieving financial independence at the end of the day is basic common sense. you must have a large salary. You must keep your expenses low. Your expenses should not increase at a rate equal to that of your salary or higher than that. For many people, it is actually increasing higher
Right.
than their income. And they should not get into too much debt. And they should invest as much as possible. I would say for early retirement or at least early financial independence, twice your investments. Twice your expenses. Excuse me. If your expenses are X, I would recommend investing at least twice that much every month. If you can do that, which is very, very difficult for most people, it's easier said than done. But if they can pull that off, then they should be. I mean, see, when you achieve it is a different matter. It depends on market circumstances, etc., etc. Too many things. But that's the path, and that's what happened to me in my case. In my case, and to this day, the rate at which my investments have increased is higher than the so-called XIRR or annualized return of my portfolio. So the money I put into it is much higher. It has grown at a far faster rate. So it's a very powerful step up SIP kind of thing, and that's how wealth grows. I mean, we should understand that for wealth to grow, the income, the principle that you put in is a very big component. People dream about multi-baggers. They'll put in a very small amount and the return will become 30x, 40x. That may happen to a very small portion of your portfolio, typically. If at all it happens. It doesn't happen for many people, but if at all it happens. But overall, I think the primary wealth driver is income. Or I would say income minus expenses. And that gap is significant. And if you are disciplined enough to put it into the market or into a balanced portfolio, I would say, then you're on your way to financial.
But sir, there are a lot of people, at least nowadays, as you said, have a very stressful job and are in the process of, are want financial freedom because they want to, get off the treadmill, right? So for them, they are always chasing a number, right? And basically, so any you have anything in mind for them? Because for them it's like it's not a shade of gray. It's either 0 or 1, right? It's either black or white.
Fairly true. See, if you look at these forums on which talk about early retirement, etc., they always talk about 30x, 40x, and so on. I would suggest you take the reciprocal of that. You take the inverse of that, and you talk about your withdrawal rates. So you talk about your annual expenses, and you divide them by the current value of your corpus, your total corpus available for retirement. And that should be, I would say, for a very safe retirement, at least 3%.
Okay.
Many people will talk about the 4% rule, and 4% withdrawal, where you pull out 4% initially and so on. But I would say 3%, you can be very comfortable because the 4% rule does not work when you rigorously backtest. It is actually lower than that. So to be on the safe side, 3% is a very safe bet, which is a big. So which would come to about almost 40x.
Okay. So there is also confusion. We all know that we have to invest, but where to invest?
See, I think young people should learn to focus on keeping things simple in terms of investments, and they should ask themselves if they want to take risks in their career. Because when you're young, that's when you want to take risks in your career. You can't take risks when you're 40 in your career because that's when you're searching for stability in your life, right? Because your kids are in middle school and you're kind of, you want a nice house for yourself and so on. So people should keep their investing very simple. I would say 50 to 60% in a simple index fund will get the job done. Just invest disciplined manner in that. Then you focus on improving your income, upskilling yourself. Can I shift to slightly, a riskier, job profile where, it's not so stable, but the income is higher. Those kind of risks you take when you're young. and you focus on your income. And maybe some people, they want to scratch their entrepreneurial itch and they want to, start a company and so on. Those are the kind of things that you do when you're young. Instead of that, what I see is young people spend a lot of time wasting time on cryptos, trading, and so. That is not those are all income sources. People should understand you trade as a source of income, and that's going to take a lot of your time. Eventually, people they give me all sort of excuses. They say algo is there, this and that, but the actual time spent for looking at the markets, looking at the screens, and so on, it's almost a zero-sum game for many people. So if they can focus on actually getting stable incomes and have a long-term plan of their incomes, but keep their investing as simple as possible, then I think they have a very good shot of becoming wealthy. Forget about financial independence, early retirement. They have a good shot of becoming what I usually call as a multi-crorepati, in about 15 years' time.
Yeah.
At least hit that 1 crore mark in 15 years' time. Like you said, once you hit that 1 crore mark, you have some belief. You feel, okay, I'm now in a different club and so on. Maybe it's true, maybe it's not, but at least it gives you some self-belief, and that's always important. So that's what I think people should do.
So, sir, I think when you are young, right, I think a lot of people, like who I talk to, basically want to get rich quickly, right? And that is how, I think that is how it is when you are young, right? If you want to go in that league as soon as possible. What would be the advice that you would like to give for youngsters? Because as you rightly mentioned, right, I think the topics for the youngsters these days are like option trading and intraday trading and crypto and whatnot, right? And they want to just earn money quickly. So any advice for them?
Yeah, so in my case, I was studying throughout my entire 20s. I would say I wasted my time study in a sense. My first salary was when I was 32. Right, that's fairly old. Of course, compared to doctors, it's not as old. Doctors is much older when they're actually stabilized and so on. Is post 35, 38 and so on. But for an academic, early 30s is when they kind of start earning. Until then, I knew nothing about money management, and I was forced to learn about money. So maybe because I was in my 30s, I was not excited or enticed by tradings kind of thing, because if slightly you become a little bit mature. But today, what happens is, after my class, of course I teach physics, but after my class, there are 2-3 people waiting for me to, until I clear all the physics doubts. They wait and they wait for me, and then they come and ask me what is the best way to start trading. Yeah. Every day I get that question, but every day I tell them, don't trade now. You focus on your career. You focus on improving your skill set so you get a nice stable job. But they won't listen. For them, it's more like it's becoming like a FIFO kind of thing. It's a gig economy where you get quick money in exchange for your short jobs. But they should understand that it takes a lot out of them. Keep doing this, either you're going to lose a lot of money or you're going to lose some of your health, wasting your time on that. But it's a process, and I think you cannot teach young people that. Some people will get it, but most people won't, and it's a process that they have to live through. And I think I talked about this in the previous episode as well. There are some things that young people won't understand, that they have to live and learn and burn their fingers before. So we generally can say that this is important and that's not, and not more than.
What about the traditional instruments like PPF, NPS, EPF, etc.? Like, what's your take on it?
See, I think the first question people should ask is, what is going to be my asset allocation? I see that people are not talking about that. They're always talking about that investment gave me this much return, I lost that much, where can I invest? They're always looking at returns as a metric, and that's the very last thing you should look at when you actually review your portfolio. The first thing is, for my goal, what is the suitable asset allocation? So typically for long-term goals, anywhere between 50 to 60% equity is enough. More than that, you're not going to get more returns. There is a very naive belief that I'm young, Therefore, I'm going to invest 90%, 100% in equity, and then I can reduce my equity exposure
There's a
later.
formula like you 100 minus you
Yeah,
dividing
but
your
at
age
least
and
that formula at least has a reducing component which regularly reduces because you can't stop time. But here people say, I'm 20, I'm maybe until 40 I will be in 90%, 80% equity. There's a fallacy that you have more equity exposure, you're going to get more returns, right? Your risk is also going to increase, and that's going to cause your portfolio to fluctuate wildly. So I think you need to strike a balance, and for the regular guy, 50 to 60% equity is enough. And they should have a very stable, robust fixed income portfolio, because this bull run will end soon. Because if you look around and talk to people, they are acting like the party is never going to stop.
True.
Oh, it's very scary. And I see forums, they say, oh, I've got only 15% return in one fund, but my other fund is giving me 25%. So I want to switch there. People act like they're always going to get returns like that. And when the party stops, your fixed income will hold you up. That's when you understand the value of your fixed income. So you should have a good chunk of it. So PPF definitely has a place. I mean, if people shouldn't go overboard. That is, investors are always operating in extremes. Either they say, no PPF for me, only equity, or they say, before the 5th of April, I will make sure I invest 1.5 lakhs in PPF because that's
I do.
powerful. Of course, you can invest 1.5 lakhs in PPF provided you are investing enough in other assets. For that, you should have the cash flow to do that, right? But if you have a very debt heavy portfolio, then that's also going to be risky. So the balance should be there. This is what pancakes.
So, as far as like, sir, I've watched your videos. I think you primarily started with mutual funds, right? And I think in one of your videos you were mentioning that, I think I should have started with index funds. So I just want to understand. So how did you? So one thing is, how do you choose your mutual funds, right? So because anyone who is starting out today, right? People look at stars, look at the past performance, right? And those things. So how do you go about choosing a mutual fund? And then in a index fund versus mutual fund, right? I think what do you think is better for a person who is starting out versus a person who is already, let's say, has done already well in his career or is close to his retirement? Like, how do you go about choosing what to buy?
Yeah. So, firstly, the way I chose mutual funds has very little intelligence attached to it. I think I made the same kind of mistakes that people do today. So my current portfolio is basically a residue of mistakes that I all did. So basically, I said, okay, I'm going to stop making mistakes and I'm just going to do nothing. Just leave it as such and let's see what happens. So that's the kind of place I am in today. But it is so nice that the data tells us that it's very difficult for active fund managers to beat the market. Not just recently, even if you take past data, that is, if you take data ending up to 2007, you can see that for any given category, only about half the active mutual funds consistently beat the index. So it is a boon for investors that the data is telling us that index is where you should be. It's the simplest place, it's low cost and also low risk because you don't have fund manager risk. As long as you choose a nice robust AMC with a reasonable fees, you're done. You don't need to worry too much about anything else. But what I would like to urge investors to focus on is think about why you are investing and not where you're investing, right? The product should be the very last step of investing. I mean, you should have a proper goal, a proper target corpus, a good asset allocation for that. And you should determine how much I should invest every month or whenever I can in this asset class and that asset class, fixed income and equity, just and then finally look at the product. The problem for investors is they're always looking at the product first and they don't have a process. And if you have the process and if you're confident about the process, I would say you wouldn't care so much about what the product is. There are many people who say, I'm very clear about my retirement plan. I like active funds. I don't care about the extra fees. I don't care about the fund manager risk. I'm very happy to take that additional risk. It's the same like saying, like what you said, I prefer direct stocks to mutual funds. That is absolutely fine. But I'm saying that choice is the last step. Have a proper plan, and after that you can take an informed choice. Of course, you have to bear the costs of your choices. Things may not go to plan. Even in index funds, things may not go to plan. So there may be a time when most active funds for a short period of time outperform the index. So everything is cyclic. There's no one theme or one idea that always works in the market, as you well know. So that's where the process will help you. You have your process in place, and then it becomes a matter of personal choice. But if you reverse that process, then it leads to confusion.
For someone starting out today, right? So the options even in passive investings are kind of unlimited, right? There are these thematic ETFs, there are small caps, large caps. For someone starting out today, I've seen so many people entering into thematic funds at the peak of their boom, and then not getting the benefits of even index investing, right?
Obviously.
So I think what is your process of choosing the place based on your goal?
So the situation is very similar to term insurance. So 10, 15 years ago, there was only a simple term plan, which very few people bought anyway. That was a time when everybody was into endowment, ULIPs, and cashback policies and so on. It was very only the plain vanilla. If the policy holder dies, the nominee will get the payment. That is all. That's the policy. It's as simple as that. Now, because the insurers have seen that many people are into term insurance, they have complicated that product as much as possible. Now you have return of premium term insurance. You have term insurance for full life or up to age 100 and so on. Now, then the confusion starts. What should I choose? And very, very rapidly in the passive space, things have become extremely complex. You have all sorts of index funds. You have factor-based indices. You have thematic indices. The primary reason for that is thanks to the SEBI rules, or I would say a loophole in the SEBI rules, because the SEBI categorization rules say for the active funds, there should only be one fund per category. That is, if we have a large cap active fund, there will be, I can only release one large cap fund. That's it. But in the index fund and thematic sectors, I can have any number of thematic funds, any number of indices. That's why you have this business class fund, business cycle funds, ESG, what do you call ESG, right? And all defense kind of fund. It's crazy. And what youngsters do is they have this app where they can buy mutual funds from. They go to the app, and the first thing they see is what are the best performers. And they say, oh, that's not in my portfolio, let's just add one. They shop like you shop in a supermarket, right? In a supermarket, you buy, your spouse gives you the list to buy, and you fill the list, and then you just walk around, you see a nice shiny bottle of juice, you pick it up, then you go to the counter, and the counter you see some lollipops or some batteries, just pick it up. That's how you can't shop, you can't invest like that. You can shop like that, but you can't invest like that. So I have a friend who is a fund manager in Europe, who wouldn't like to be named, and he told me something very insightful. He said that any new bright idea that comes to India, by the time it comes to India, it had already peaked and started falling in the West. That is, people have got excited about it in the West. In the West, meaning any other place where there's a lot of money. And already the AUM has flowed in because of that idea, and the idea already started underperforming, and people have started criticizing that theme or that idea, and only then it enters in the Indian market. So there's a big phase difference or a phase lag between. So that is what is currently happening with respect to factor funds, I would say, in my opinion. People have in the West, they have realized, Europe, US, etc. They've realized that factor investing is not always going to outperform a simple market capitalization based broad index like the Nifty 100, Nifty Sensex, etc. So that's also going to go through cycles. And that's currently happening. And we have seen that happen, for example, in the mid-cap quality index that started underperforming when the mid-caps were actually booming. So that's going to happen. It's a matter of time before it happens to every theme or every factor-based index. And people should be ready for it. Everybody wants the return, but nobody's willing to be patient. And if you want that extra risk, whether you invest in a Nifty Next 50, which is a little more riskier than the Nifty, or you want to invest in some momentum index or or an alpha index, there will be periods of underperformance. Are you ready to hang in there? Most people are not. That's the problem. So it's easier for them to simply choose a Nifty or a Sensex. They want a little bit more risk, maybe have some exposure to Nifty Next 50. That is it. You don't need any other one or two funds, passive funds. You don't need any other fund in your portfolio, is my opinion. Of course,
So, sir, I think so. Anyone who asks me, about investing, I always say there are, three things. One is process, which is always the first thing, then patience, and then finally courage, right? So I was looking at your journey, and then basically I realized that after 2008, I think you mentioned that there was a 5 year or 4 year period where I think you almost made zero returns or negligible returns, right? I feel anyone who is starting out today has not seen that, right? Anyone who is starting out has made good money. They have not seen how markets truly behave when or what could go wrong, right? And then I feel most of the people who start out with a journey like this, 4 or 5 year of underperformance, most likely will like close it down thinking that this is not the right place to be, right? So I want to understand what gave you the conviction to, because I think for you stock market would have been a similar, and so like most people would close down. So what gave you the courage to continue or to add more during the crash? And I think it comes with experience. But when you are starting out, what gave you the conviction to keep on doing and keep on repeating?
Yeah, so when I tell this to young earners today, I get a lot of stick for that. They tell me, no, you did not know how to invest. You could have easily made more
We are
money.
the smarter ones.
They would have easily made more money. And they say, I don't believe you. I think you're fibbing and that kind of thing. But that's, I find that amusing. But see, in my case, I think I used something which what I now like to call as emotional logic. Because I had gone through that debt, during that phase, I was also in debt to my brother-in-law. I had to pay that money back. And I told myself, I have a lot of time because my retirement is only at 65. And in 2008, that was very far away. I was only 32, 33 then. So I told myself, why not just wait? What's the worst that can happen? Because you have a lot of time to wait. And I told myself, because thanks to what I was reading at the time, I soon realized that the market behaves like that. The market behaves in a clumped manner. Suddenly it'll give you a huge return, and then it kind of there'll be a period of lull, and then so the returns are kind of clumped for somebody who doesn't do anything active. Somebody who just rides the market. And so I kind of told myself, maybe it's okay to sit it out. But I did have some pressure from my wife and my mother. They were not very sure that I was doing the right thing. I was also not sure. I mean, in hindsight, it seems okay. But during those times, every time I opened the portfolio, it was always red. That was crazy. But what gave me the courage to stay was the fact that I had the time. I said, I have the time, so why not wait? And you are right. Conviction makes a very big difference. I don't think I had conviction at that point in time. I was just looking at the time, and I told myself, if I'm just going to stick to fixed investments, I'm going to end up like my parents. I'm going to end up with a portfolio, which is largely fixed income, and I will not be financially independent. And so I told myself, why not give equity a chance? It was not I would say, an easy decision. It was not a clear, it's not as if I was thinking clearly on everything. It was a hunch, and I mean, just paid off. That's all I'm saying.
So like what about some people start comparing Indian market with the Japan market? That Japan market is going sideways from like long time. So this could happen with Indian markets also.
I think Shubham will answer this much better than me. I think the biggest problem in India, I think, is some kind of corruption, some kind of scandal that has a domino effect, and you're gonna have some maybe a dip, and maybe at worst you're gonna have a few years of poor returns. And we just saw that recently. So if you from 2018 to 2020, before the COVID crash, if I'm not wrong, only the large caps moved up. The mid caps and the small caps were falling down. That kind of a scenario is much more dangerous than what happened in Japan. The Japan case is very different. They have a very different economy. I talked about it before. They're a very small country and the population is decreasing. So there it's much more harder for businesses to sustainably get profits. That is my limited understanding based on what I see. But that may not be the case in India, where there is a lot more scope for the population to grow. We are still a young country and an old country as well. We are simultaneously in both, I would say. And we are a much more larger country. We have a lot more lung space compared to Japan. So I think there is, at least for the next 30 years, I think businesses should be in a position to generate good profits. I think our biggest enemies are global warming, I would say sudden changes in weather cycles, extreme weather events. Those kind of things can impede us much more than a large, like 2 decades of poor returns like the Japanese markets. I would say that is the bigger risk. But all in all, there is a reasonable chance. See, the problem with youngsters today is if you tell them equity does not have guarantees, they are annoyed. I'm just telling you the truth. I'm just telling you what the mutual funds say. It's like, every time you pick up a pack of smokes, you see that you see a guy with lung cancer right there on the picture, and
Yeah.
you still smoke, right? It's like that. People don't want to understand that there are no guarantees. You will have to be agile, and you must have a plan in case you don't get returns. And but all that said, equity gives you a reasonable chance. There is a more than reasonable chance of making money, beating inflation, which is the primary thing. And you don't get that kind of a chance in most things you do in life, right? Whether you join a college or whether you join a job or whether you are in a relationship, I would say the odds of making money in equity are higher than becoming, successful in your college or a relationship or whatever, generally speaking. That's good enough. That's more than good enough. But there are risks, and you must appreciate those risks. That is my opinion. Of course, I'm happy to hear Shubham's opinion.
Shubham's thought, yeah.
No, I think I totally agree, but I think my perspective is largely different. So, what I feel is, there are all. So I think first comparing with the Japanese market. So Japanese market, for example, if you look at what happens in between 70s to 90s, the bubble was much bigger than what it is in India today, and so the bust was even bigger. So if you look at so I think ultimately in the long term it's a matter of valuation and growth, right? These are the only two things that matter, and rest everything falls into place. So if you look at growth, I think comparing it with Japanese would not be the right thing, because at that time their per capita income was very was much better. I think India, we are hardly at what, $2,500 per capita, and I don't know if we can go to like $20,000-$30,000, but I think there is a high chance that we'll go to $7,000, $8,000, $10,000 per capita income, and over the next obviously 10, 15, 20 years. And then if you look at the like we have obviously a young population, a large labor pool. Manufacturing jobs are hardly a very small factor. I think whatever 15-16%, we can go to 20-30% easily. So, and plus forget about all that, I think within an economy there are always certain places which do better than other things, right? So even if the index does not go to wherever it goes, there will always be. So for example, right, if you look at UPI, for example, right? So doesn't matter the economy was doing good or not good, right? Well, let's say the economy was doing 4% GDP growth, but there was a trend. There was UPI which was growing like 100% in a year, right? And I don't know, many people know about it. There is a listed company called NPST which directly benefits from the UPI growth, right? Because they provide APIs to banks, and every time somebody is doing a transaction, they are earning some money out of it, right? So
Um,
I'm an active investor, so I try to figure out places and trends within the things where, even if the economy is not doing that well, I know I am reasonably certain that this is a trend that will do good. And if someone is willing to do that work to figure out the beneficiary of a trend, I feel at least they will do good over the long term. Sir, if you had to start everything all over again, I think based on your experience, what would you change, or how would you do it if you had to start all over again?
I think I'll just stick to what I just said, put it in an index fund.
Okay.
And what I mean, I think because it's so much easier for everybody to manage. In case I'm not around to manage it's easy for my wife to, pick up things and handle the portfolio for my family. It's easy. It just takes away the headache of worrying about it. I want to be an investor uh, or a money manager. I would say I'm not an investor. I want to be a money manager where I don't have to look at the markets every day, every week. I don't have to follow financial news every day. I just don't want to look at it at all. Maybe 15 to 20, 30 minutes a year is all I want to look at my portfolio. The only thing I want to track is how much I put in every month. Am I doing that in a disciplined manner? And that will build me the wealth. And I would say, I mean, that's what I'm trying to head at. So which is why I even now I don't follow a lot of news that goes on in personal finance space. People expect me to know, but I don't because I'm trying to not know.
Yeah.
So yeah,
I
that's
think
what I'm.
I think a very interesting thing that I can try to pitch in is, I think people, so all these TV channels, all these newspapers, right? They basically try to portray as if when you know everything about everything, you are an expert. Right? So any stock you talk about, they always have some view or the other, right? So, however, in my experience, it is the opposite, right? The less things I know about, the better, right? I just want to focus my energy on the 10% of the things that have a very high probability of success, and just don't know about the whatever what is going on in the rest 90% of the things, right? So any comments on that? I think that is relatable even to, when you, because I think the questions that everyone would ask is, what if the interest rates start coming down? What if there is a war tomorrow? What if, so that the number of variables you can keep adding to the equation is like any number of right?
Correct.
And then when you try to optimize for everything, right, you basically end up optimizing nothing.
Yeah, you'll get nothing done. I mean, I know many people. It's the same thing with a term insurance plan. No, I know a guy who waited 1.5 years for buying a term insurance because he was researching for that was a huge risk. I mean, he would have died within those 1.5 years. That is what happens. This inaction is the worst thing. Even do something, invest. That's why I'm saying choose the simplest.
Yeah.
Even if you want to become a active investor,
Yeah.
I would say have a base as an index fund base and slowly increase your exposure to active investing.
Yeah.
Right.
So I think I'll try to add with my little experience. So what I do is I am an aggressive investor. So I generally try to keep my allocation to 90% or higher. I just want to keep some cushion like next 1 year, and then whatever is remaining, I just want to be deployed somewhere. And there are a lot of times when I sell something and I have cash and I don't know where to put the money in, and so the so I just put it in an index fund. I don't want to, and that comes with a risk. Obviously the market could go down, but I mean, my thinking is that I want to be invested all the time, right? And then once I don't know, I don't have a clear trend, I don't have a clear idea where I can put in big money, just let it rest in an index fund, maybe for a year, for an year and a half, and then slowly the index fund, it will again go back to the active. That's what I do, but yeah, just wanted to.
No, no, the thing is that, see, going from point A to point B, there are you can draw a million lines.
Right.
But the question is, are you drawing the line yourself?
Yes.
And in your case, you are. So, therefore, it works for you. Because the problem with today's investors is they don't know where to start. And they look at somebody and start one part of the journey. And after that, they look at somebody else and they change their journey. And they keep changing the journey and they don't know. Finally, they don't know where they're going to go. Right? And you should have the conviction to choose or reject securities or any other product entirely on your own, based on your own research. And then anything goes. Anything goes. 100% equity is fine as long as you do it yourself. You own up to it. There's nobody, you're not looking at some influencer and saying 100% equity is good. It's your choice. That is different. That decision making is what is missing, I would say, amongst most of us.
So there's a concept called SWP. Like people are very fascinated about it. So can you tell what it is and like should we go with it or like what?
See, to be brutally honest, it is being propagated by or promoted by the mutual fund industry because think about it this way. A lot of people are retiring, right? Especially in the tech sector, anybody above 45, they're going to retire anytime soon, right? And if they've been working in that job for 20 years, let's say, they will have a corpus of a few crores easily. There are many crores in India. Although you see people cribbing, I'm a common man, government is not doing anything for me. Lot of cribbing, but I personally know more than, I would say, 300-400 crore. Lot of crores, and some of them do call themselves common man, which is atrocious. So this money is, the mutual fund wants to target this money. They want to target retirement planning. Now they have the mutual fund Sahi Hai campaign has now worked for the SIP part. The accumulation phase has done wonders. The AUM growth is very good. Now the next step is to focus on the retiree money. Right? You take this chunk and you put it into a equity fund or any other fund, balanced advantage, whatever kind of fund, and then the guy selling the fund will get a trail commission on that. And right, you're going to take and you're going to withdraw systematically from that, and you're going to say you can do all sorts of back testing and say I put in 1 crore 20 years ago, in spite of the 2008 market crash, in spite of the 2020 market crash. Look, my final corpus is higher, even though I kept withdrawing this
Yeah,
much
that
money.
is the match. Like they,
I can also do this math.
that is the sales pitch. Yeah, that's why like, it is so lucrative.
It is very dangerous. First of all, it is very dangerous to withdraw from a volatile product. Right? If you are going to withdraw from a volatile product, and if that product encounters a series of bad returns, you're going to draw more and more of the corpus, right? And you're going to run out of that money soon. This is a big risk. SWP is absolutely fine. Of course, there's no need for an SWP or there is no need for an SIP. It will take exactly 45 seconds to 60 seconds to invest in a mutual fund or redeem from a mutual fund. If people don't have the discipline to invest regularly, spending this much time, they don't deserve any wealth. People say SIP brings you discipline. SIP has nothing to do with discipline. SIP is just automation. You must have the discipline. A product cannot, or a method of investing cannot make you discipline. Similarly, there's no need for an SWP. You want the money, redeem it. You're going to get it in 2 days. So you adjust your redemptions. Why do you need to set up an SWP?
Yeah, I think a very similar thing that I heard very recently is I think in US they have a lot of these things. Whenever you buy a coffee, the last few cents they will put it in the stock. So if you buy a coffee for, let's say, $2.80, so they'll put a 20 cent in the stock market for you, and then they propagate, like, people don't have the discipline, and so whenever you're spending the last 5 cent 10 cent, they're automatically putting in. I'm just thinking, no, why at the end of the month, why can't they just put like $1,000 or 2,000, whatever, like, and I think the same thing is slowly coming to India as well. A lot of these fintech companies will slowly come out with these products where, with UPI, whatever the last few
Oh,
rupees, they will start investing every 1 rupee, 2 rupee. I think
oh.
that is another.
But conceptually, it is good. Like,
No, see, it attracts people. I agree that it attracts people. But I'm saying if you actually look at the logic, a product or a method of investing can't make me disciplined. Discipline is
right.
something else, right? And so I'm saying you don't need an SIP or an SWP. If I want money, actually, let's say I take 1 crore and I put it in, let's say, a liquid fund, and I'm going to
That's what
manage.
I'm saying. Like, can we simplify it a bit more so that everybody can understand using numbers? What is the
So,
sales pitch first? Let's say what people say is like if you invest 1 CR and then because you'll get like 12% return, and even if you keep on, withdrawing 10,000 rupees or 70,000 rupees every single month. So the math goes ki after even like 10 years, you'll have the more corpus than what you started with.
see,
And what is the reality like? Can we
that is
take the
up
examples?
because you're not going to get 12% every year. The markets are
Yes.
going to fluctuate,
So can you
and the
quantify so that at least people can understand? Because
um,
when you take
if
the
you
numbers, it is easy for them
if I
to
look out the graph,
comprehend.
I mean, it's see the thing is very simple. It's see that 12%. It's anybody who has been in the market for 3-4 years even will know that you're not going to get 12% every year. Then
Right.
even in the last 2 years or so, it was less than that. It was just like 1% or so. So in during those poor periods, you're going to withdraw more. Your corpus is going to come down. So eventually, if you hit a poor sequence of returns, especially in the first few years of your withdrawal phase, then the corpus will fall down much faster. It will get depleted faster. The simplest way to do SIP, if at all you want to do an SIP, is put that money or take part of your money and put it in a liquid fund or a money market fund where the NAV will not fluctuate too much. Where it's a very simple, almost a linear growth. Then you can happily do a standard SIP of pulling out 30,000 rupees every month or whatever, how much ever money you want or units or whatever. Then you put some part of your corpus in your balanced advantage fund or equity fund or whatever kind of so-called aggressive funds, and you use it for discretionary expenses. Let's say I want to take a holiday and the market has done well, then I pull money out of it. That's entirely discretionary. I don't pull out every year. I pull out when I can afford to pull out. Whereas the money market fund or the NAV liquid fund, excuse me, that I can use it for regular expenses. I can set up an SWP there for regular expenses and use other kind of products which take more risk for occasional expenses.
Right, right. I think another way to put it is would basically divide, and that's how I feel is a good way, that you divide your money into two buckets. One is, a cushion, and then everything above that is kind of the riskier asset, right? And then whenever you SWP is running, but on the where on your
The
cushion,
FD is
which is
going.
like whatever 2 year, 3 year, a decent amount of cushion. And then whenever you feel that the riskier asset has given you a very good return, you basically pull in some money and put it in your whatever the liquid or that kind of fund, in your cushion.
Yeah.
That would be a slightly better approach than trying to pull out money continuously out of the riskier fund.
Yes. And the sad part is senior citizens with not much of a corpus, they're being targeted for this kind of an SWP sale. And that is very dangerous because they would not have the capital market experience. At
Yes.
least if you say I've been investing in mutual funds for 20 years before retirement, you might have seen a few bad years and it gives you some kind of knowledge. But as a guy who has been in 100% fixed income suddenly retires and says I don't have enough money. So these guys recommend putting it in a balanced advantage fund or an aggressive hybrid fund. That's very risky, very dangerous.
So what about the female population? Like the participation of female population in investments or like the financials as whole, like is very less as compared to other Western markets.
Yeah, this is, I'm not even sure I'm qualified to even talk about it. Otherwise, people will think of it as mansplaining. I don't want to do that. It is very low. That is a fact. You can't change facts. And I'm not sure why. And I think I mean, many people, many readers, they ask their young daughters to meet me, young kids, sons, and the first thing I tell the daughters is, be independent, have your own source of money. Even though your husband is, has a much higher income than yours, and you don't need to earn. You earn if you want to, and if you're interested in follow your passions and be independent, financially independent at all times, and keep your money separate. Whatever your income should go into investments with you as the first holder, and the same for the husband. So that way, there's always some kind of independence, and also that automatically puts in some responsibility as well. Then it's your investment. You want to look at it. Of course, that is changing to some extent, but it's relatively very. I mean, I don't know if I can even talk about why and so on. Maybe that's how they're wired. I don't know. It's
Culturally, might be like,
maybe, I don't know. I mean, it's a hard topic to get into, and I don't know to talk about beyond that much.
understood. Like, so how to inculcate these habits to a youngster? Like, let's say, if someone has a child, at what age it would be appropriate to start telling them about the money?
I see. I think the moment the child wants something, children they say there's this nice toy, this shiny objects. Children have the shiny object syndrome, and investors also have shiny object syndrome. But the moment children start saying, I want this and that, you tell them, look, I'm not going to say no, but I want you to do research on the product. You search on the net, you ask around with people who have it, use it if you can, find out what are the better options. Tell me which is the best bang for your buck, or my buck, I would say. And if they do that kind of, if you inculcate that mentality to do research before buying, you can get rid of, to some extent, impulse buying. Right? You can delay gratification, and hopefully that when they become money managers themselves after they start earning, hopefully they'll do the same when they start investing. They will not blindly, choose a tax saving product. That's the number one mistake people do. The first year of earning, the first thing they do is they buy some product which saves them tax. Many still don't even know there is a new tax regime where you don't even need any ATC products. You can happily, save less pay less tax, by using the new tax regime. So that kind of a research attitude, if you can put into children, hopefully it will pay some dividend.
Understood. Sir, which is like the most read article in your website, Free Frinkle?
I would say, so if I can draw a graph between usefulness versus traffic, it will be an inversely proportional graph.
Yes, that always happens. So we can first talk about traffic.
The catchier the headline, I think, I don't know these numbers, but recently there was this guy who called Arun. He has a 15 crore portfolio.
Okay.
And he wrote 2 articles. One, he said the growth, how my 15 crore portfolio grew. And then he broke down each crore and how long each one took and so on. And I think that had a lot of, it polarized people. It had a lot of traffic, and it also polarized people. Some said he's lying, and the usual kind of polarization. They agreed with him. They said it was inspiring on one side, and the other side, no, this is not possible on the other. It's non-linear growth is always hard to visualize. You can't visualize that so easily, especially when it starts growing. Initially, when it's not growing much, you can probably project it to some extent. But once the snowball becomes huge, you can't project it. You just have to let it enjoy
I
it.
think even me and Shubham did a similar kind of video on the similar topic. So it was like why your net worth explodes after 1 CR.
And that did well.
Yeah, and that did well.
And it had similar comments.
Yeah.
No, I mean, you are not popular unless you get some stick. So
Right. But mathematically, like that is true. In like absolute terms, you actually make more money. And that is like if I try to deconstruct it from like human psychology perspective, it is more like the desire or you want to be at that position or at least you have a number to chase to. Because some of the people were commenting like, why not let's take a loan of 1 CR and start from that only?
See, I had I was talking to a group of students and I asked them, suppose I tell you the name Elon Musk.
Right.
What is the first thing that comes to your mind when you hear Elon Musk's name?
Genius.
And people, all sort of things. They said Martian. They said pump and dump guy. All sorts of very bizarre names. But I said, I was very disappointed that nobody said hard-working guy. Elon Musk works very, very hard. Maybe
Right.
not now as much as he did in the past, but he worked extremely hard. And so people are always looking at the wrong aspects. When you hear a story like Shubham's story or anybody else's story, they're not looking at the kind of perseverance, the effort that it went in. If you look at that, that is when it will inspire you to follow a similar kind of journey or chart your own course successfully. Or if you look at the wrong things, no, this guy is fibbing. He must have more money. He's just giving me wrong numbers. All sorts of comments. Nothing productive is going to happen there for them. That is.
Even in your case, I think the people would comment the same things.
I think people don't comment about my intelligence because they don't find much of it on
No,
display.
no.
But I can tell you this. In my 8th standard, I flunked almost all my subjects. So I was the kind of guy the parents said, no, don't join with him. The mother will tell the son, like, no, don't join with that guy. I was that guy. Things change. That's what I
Right.
tell my students these days. Your mark is not a reflection of who you are. Your mark is just a reflection of the effort you put in and how serious you took the course. If you want to turn things around, you have to put more effort, right? And so you have to focus on the right aspects and then things will work for you.
One question, sir. Is intelligence correlated with money? So this is like another viral topic. Is intelligence is equal to money?
Absolutely not. Just like intelligence is not correlated with marks. Every time I start a course, I tell them, my first thing I tell my kids is intelligence has nothing to do with, it's a process. If you follow a process, you'll succeed in a system. For example, in a system like IIT, if you follow a simple process, you'll work. The same thing works with investing. It has got nothing to do with intelligence. It is just common sense. And conviction, the word that Shubham used, extremely important. Conviction, because there are like a million things to derail your plan today. If you just get on social media, get on the web, and if you do not know how to process information, you are a lost guy. And most people don't know how to process information.
I think I have a question. In today's world, I think there is too much too much data, right? And too less information, right? So you will get all kinds of information. So then how does one develop a process to stick to the goals and, continue the journey?
See, this is one of the reasons why I chose not to get into active investing, to be honest. Because I realized in active investing, you need to be slightly more active in terms of information gathering. Although it is focused information, you must go out and seek it. You can't be a lazy guy and say, I'm going to put in some stock that looks good. Some portal has got some 5-star rating. I'll put it in and forget about my money. That won't work there. So I think that, like Greek philosophy says, all the answers lie within, especially the basic answers. Like, why am I investing? Why do I need the money? What are my future goals? Retirement, financial independence, my child's college fees, anything else, etc. You list these things and you ask yourself, what is the most suitable plan in terms of risk, reward, etc. for each of these? And then you work on the products. If you do that, I think you can weed out much of the information around us. It is, if you focus on the products first and don't have a process, it's impossible to filter out information. Every news will look like a important news to you because if you're a mutual fund investor, you have articles in your Discover feed that says, last few years, this mutual fund has given 45% return. This mutual fund has given minus 15% return. Then you say, oh my God, should I be in that? Should I sell this? You're going to ask all. Instead of that, if you focus inwardly to your own, what is your, like people say in active investing, you should have a proper investment philosophy, print it and put it somewhere. And every time you're in doubt, read it, turn around and read it. The same thing happens with personal finance also, goal management
So
also.
I can totally correlate with it. I very clearly remember. So what happened is, I think 4 months ago or 5 months ago, I don't remember the exact date. One day, my mom called me, and the market was, I think, down on the last few days. It was down what 4 or 5%, something like that. Not by a huge amount, but the market was going down. And then there was an article in the in not, she doesn't read Economic Times or anything, in a normal news, I think Dainik Jagran or Amar Ujala, something like that, which was by some foreign mutual fund guy, or some big guy. I don't remember who that was. And she was like, and his article was that the in the next 1 month or next 2 months, the market is going to crash. And my mom was very scared, and she called me and said, I read this article today and the market is going down and the market is about to be crashed. I said, okay. So I said, so what are you doing about it? So, so I'm like, I mean, so over time, what I have realized is, if you start, so I have a WhatsApp message. I told her exact same thing. I said, every month someone or the other will write a similar article saying the market is going to crash, right? If you start listening to everyone, then you will not never be able to participate in this journey, right? And then I said, okay, I have a process. I follow a techno funda investing. So unless the
Yeah.
fundamentals go wrong, or the fundamental valuations are crazy, and then the charts go wrong, and then the combination of, so unless my process says I exit, right, I will not listen to anyone. So I think, yeah, I could totally correlate with what you said.
No, that takes a lot of conviction. So
Eventually,
confidence.
conviction is I think, the key. So nowadays, I think it is more important one to like get signal out of the noise. So psychologically, like the psyche is more important because like information is there. Just take those few nuggets, as you said, write it on the paper and just follow that.
No, a
Ignore everything.
lot of these things, investment talk happens in the water cooler or the lunch area. No, people ask
Yeah,
where you invest. They overhear conversations and some of them invest based on that. That is very wrong.
and that is the worst time to invest actually.
Yeah,
There's a book by Peter Lynch. He says when this is happening,
yeah.
that means you have to exit the market, that particular stock.
No, same thing. What Shubham said. No, people invest in a thematic fund only by looking at these paper. This fund has given 200% returns over the last 1 year, and then they'll invest. After they invest, it'll start falling down. It is uncanny that happens.
Yeah, so I think the final question would be, should one aspire to become financially free? Any pros and cons that you saw of doing this? So I mean, for you, I think you're still working, but a lot of people, cut off, or basically, basically stop doing their jobs and then they actually retire. So any advice or any views on that?
See, my experience tells me that only those who have a very clear plan of what they want to do or why they want to retire early or why they seek financial independence, only they are successful. And many of these people, either they want to, uh, freelance or they have a, startup of their own. Uh, Only those kind of people are successful. Generally saying, because I see their life, somebody's lifestyle, rich cars, or going on holidays, and that's why I want to be financially independent. I want to put my feet up. That kind of attitude, I think, is a very flawed one. And I think for most people, it is better to have a balanced approach. That is, there are many things that you can do only when you're young. So some things you must seek out some adventure. You can spend on your wants when you're young, but also invest for your future needs and wants. So that if you strike that balance, just don't have a fixed target for financial independence. Let it come when it comes, and when it comes, you can take a call then. For example, in my case, I never even knew I became financially independent. Everybody around me started talking about it, and I just, what about my portfolio? I should go look at it. And then I thought, okay, I was. So I mean, it's better that it happens, due to serendipity, instead of you looking at it every day. Do I have 30x or that kind of thing? Watched kettles don't boil. So it's better to leave things and have fun when you can.
Right. Thank you so much, sir, for coming to the
Thank.
podcast.
It was a pleasure. Thank you, Shubham. It was wonderful interacting with.
Same here, same here. Thank you so much for coming to the podcast, sir. I think I had the same feeling.
Thank you.